You're listening to the Daily Fiscal Pulse for the 10th of August, 2026. This is Monday's data we're working with, which means these are finalized numbers, not preliminary estimates. Let's start with the bigger context before we drill into the actual cash flows. Right now there's no clear dominant narrative driving things, but you're seeing headlines like CoreWeave stock pops 12% as revenue doubles on accelerating AI infrastructure demand, and that's definitely influencing market movement. Still, headlines and actual flows can tell very different stories. We'll let the numbers speak for themselves. The net fiscal transfer for the session came in at $13.6 billion. In isolation, that's not alarming. What matters more is the trajectory. Over the past 5 days, flows have contracted to roughly half their recent pace. The standout figure here is tax receipts, which posted $25.8 billion. The equity futures paint a different picture, though. ES closed at 7,778, trading above the 20-day moving average of 7,572. The broader 20-day trading band is about 474 points wide. Despite the fiscal headwind, price is holding its ground. Pull back a bit and the pattern becomes hard to miss. Daily government spending averaged about $0.1 billion over the past 5 days. Against the 20-day average of roughly $9.4 billion, that's a sharp deceleration. Less liquidity entering the system means less cash flowing through the real economy and into markets. Financial conditions are contracting as a result. The year-over-year comparison confirms this. Fiscal year-to-date spending stands at $1,454.2 billion, down about 13% compared to the same stretch last year. That's a significant pullback in fiscal support, and it does influence overall liquidity dynamics. For market participants, this fiscal backdrop is worth taking seriously. Our conditions gauge is at -71, which isn't a tailwind. That said, we've been in similar situations before. Even when liquidity tightens, the S&P has historically averaged around plus 1.5% over the following month. Markets and liquidity don't move in lockstep. Gains can still accumulate even in tighter conditions. One thing to flag on positioning: margin debt is sitting at the 100th percentile, which is elevated. Historically, that extreme tends to function more as a caution sign than a bullish signal. Here's what ties this together. With fiscal flows running below last year, the financial cushion is thinner. When sentiment turns positive, markets can still climb higher, but when a risk event flares up, whether that's an escalation in the broader narrative or something else, downside moves can accelerate because there's simply less cash underneath to cushion the fall. Worth tracking: we've seen 3 straight days of declining fiscal transfers. That pattern usually shows up in price action within a short window. There are some scheduled flows ahead that could reshape this picture. The 12th of August marks the SSA payment cycle on the second Wednesday, which tends to shift near-term flows meaningfully. Around the 15th of August, the next major Treasury coupon interest payment window opens. Fiscal pressure is definitely visible in these numbers, but the rate of contraction might be stabilizing. How these upcoming scheduled flows land will likely determine the next move. That's where our focus is.